Alrighty, so let's get into today's video. And in today's video, I'm going to be sharing with you what I believe is the number one secret to becoming consistently profitable when it comes to trading options, right? So I really want you to pay attention to this video because I truly believe that this is the most important video that I've created so far, if not one of the most important videos that you really should learn and implement. Alright, so because I think that if you go ahead and use this secret which I'm about to share with you, it's going to really help you become consistent in the results that you get when it comes to trading options. Alright, so what is this number one secret? So this number one secret is none other than what's called the expected move. Right, so I've actually previously touched on this rather briefly in my previous video, but today I want to go a little bit more in depth into this. As well, I'm going to be sharing with you a year's worth of trades that I did around the expected move, so you can take a look at the results for yourself as well. Right, so the very first question you might want to ask if you're unfamiliar with this term is, what exactly is the expected move? Alright, so the expected move is basically the amount that a stock is expected to either go up or down from its current price, right, in by a certain time based on its current level of implied volatility. Alright, so basically it's how much a stock can move, right, based on the days to expiration left. So basically when we are trading options, you can see that there are these numbers down here which is telling you when these options will expire, right? So based on the implied volatility, it's going to tell you roughly the expected move that a stock will make either up or down, right? So if you are a mathematician, you really like to take a look at the formula, you can see this is the formula. Right, I'm not going to go in depth into it, right, because the good news is that there's really no need for you to calculate this yourself, right? There are trading platforms that actually show this to you already, so all you have to do is just get the numbers from your trading platform, right? For example, this is TD Ameritrade. Think of Swim platform. You can see that when you pull up your option chain on the right hand side, you will get to see these numbers, right? So the percentage wise is basically the implied volatility, all right? And on the right hand side of it is basically the move in terms of the dollar move based on this implied volatility. So you can see this number down here says plus 16, plus or minus 16. That means it will go up or down 16 points, all right? So it's plus 16 on the top and then minus 16 below. So basically this is what the expected move is. So why is this very important? Right, so this is important because when you're using expected move, it allows you to devise a strategy around this, right? If you know roughly the range that a stock will move at any given moment, let's say for example, if you think that the market could go from this range to this range, all right, let's say for example the stock price right now is this, all right, so this is my attempt at drawing a candlestick. Right, so at this point of time, this is where the range could be based on the implied volatility. Now, historical statistics have shown that the implied volatility usually overstates the actual volatility. That means that prices tend to stay within the expected move more than the probability suggests. So for example, if the implied volatility says that the range should be somewhere from this point to this point, well, the actual volatility, right, actually could be much narrower. That means it could actually only move from this point to this point. Now this is actually important because when we are trading the expected move, right, you can put on strategies that just trade in this range, right? So I shared in my previous video market neutral strategies. That means that you actually do not have to pick a direction in order for you to make money from markets, right? So the traditional way of trading is that if you want to make money when the market goes up, right, you normally just buy it, right? So in hopes the market goes up. If it goes up, you make money. If it goes down, you lose money. And if you short the market, right, let's say for example you just sell the shares. If it goes down, you make money. If it goes up, you lose money. But when it comes to trading the expected move, you actually do not really have to pick a direction. You just have to say that, hey, I think that the market is going to stay within this range in the next number of days, which you have chosen based on the days to expiration. And then if it stays there by expiration, you're going to make money. Alright, so here's the cool part about this. So probability suggests, right, based on the expected move formula, right, they have all this calculation, it states that the probability should be 68%. That means that it will stay within this range 68% of the time, right? From this point all the way to this point, the probability is 68%. But the actual occurrences within this range tends to be higher. And if you can see, this is a study done by the Tasty Trade team, Let's just take a look at this expected move formula on this left hand side. So basically what it's trying to say that the actual occurrences is actually 85% instead of 68%. That means it actually stays longer in this range more than what the probability suggests. That means you actually make money more of the time. So let's say, for example, you receive a premium of, let's say, $2.50, which is $250 for trading this range. And let's say, for example, you put on a strangle, all right, or an iron condor, all right. Let's say you get $2.50. That means to say, if the market stays within this range by expiration, you're going to receive the full credit of $2.50. Now, by probability, right, from this calculations which they have made, it states that you will only make this $2.50 68% of the time. But in actual fact, you do not just make 68% of the time, you actually make 85% of the time. And then 15% of the times, it will be losers, right? So that means now you have your expectancy skewed towards your advantage. Right now, you have a higher than usual way or usual rate that you're going to make money. So that is why in the long run, you're always going to have a positive expectancy because this number is actually skewed in your favor, right? So this is the studies which is done by Tasty Trade, and they even went even further to find out how this actually works in ETFs, right? Index ETFs. So if you were to take a look at this table down here, you can see that on the left hand side it says the average realized move. That means this is the move that the market actually made, right? The average expected move is based on the implied volatility. That means before the move has been made, they came up with the formula based on the expected move, and they say that it most likely could move around $16.57, right, in this range. But instead of actually moving $16.57, the actual realized move is much lesser than that, and that's $10.81. And they even broke it down, right? So they broke it down, as you can see down here, they broke it down by the IV rank. So you can see that when there is low volatility, the expected move is actually also higher than the average realized move. And even when it's times when there is very high volatility, and high volatility normally is when there are market crashes, right? The market moves a lot. You can see that the expected move, right, far surpasses the average realized move. So you can see that actually in all instances, regardless of what the implied volatility rank is, right, the expected move is always more than the realized move. So this is for SPY. Right, you can see it's the same as well for the other index ETFs which we have done the studies on. You can see for IWM as well, the expected move is higher than the realized move in all instances, right? It's all higher. Again, they did it for this QQQ as well. So you can see QQQ as well. QQQ tends to be much more volatile than the other two index ETFs, and even with this index ETF, you can see that the expected move is much more than the realized moves. Alright, now the thing is that this implied volatility do not overstate the actual volatility in all time frames, or rather in all expiration dates. So you can see that they also did a further study to see when the expected move actually is bigger than the realized move. So you can see this is a study that they did since 1993, and this is about 30 years worth of research, right? So this is pretty statistically significant because there is a lot of data points that they have taken from, and you can see that the time where the expected move actually exceeds the actual realized move is from the 45 days mark onwards. But anything before that, you can see that it actually does not exceed, right? It's only 45 days from the 45 days marks that it exceeds. What does this mean? It means that when you want to trade the expected move, and you expect it to stay within this range, then you want to choose the days to expiration that is 45 days and greater. Now, if you were to take a look at the longer days, you can see if it comes to 60 days and 90 days, the discrepancy is even bigger. You can see that from here, the expected move is 7.9%, but the realized move is actually 6.5%. So there's a 1.4% difference. Down here, there's a 0.5% difference, and if you take a look at 90 days, there is a 2% difference. So what does this mean? So it seems as though that it becomes a little bit much more unpredictable, the kind of move that the stock or the market will make as the time frames gets longer. So it's almost as though they want to overcompensate for the move because they're not sure, right? So in a sense, it's something like, I rather have a larger margin of safety, than, if I make it smaller and then if I get hit and then I'm wrong, right? So they rather make it bigger in a sense whereby the implied volatility, they overstate it by much more than the actual realized move that is made, so that, in the long term, there's much more room for error. But if you were to see that in the shorter term, it's pretty accurate, right? So this is pretty efficient. You can see that the expected move sort of kind of matched the realized move, and in fact, in this 4 time frames, the realized move is more than the expected move. But as it gets longer, that's where you can see the difference is, right? The expected move is much more than the realized move. So that is why when we come to trade our trades, our options, we want to choose for somewhere from 45 days to 60 days. For me, the sweet spot is from 45 days to 60 days, because anything that is longer than 60 days, 2 things happen, right? Number one, basically the theta decay is not as high, right? The theta decay is not really as accelerated as compared to when it's slightly closer to the expiration date. So that is why I do not want to typically go above 60 days. And number 2, you notice that the premium that you get kinds of dropped off, right? So for example, if 30 days, right, let's say for example 30 days, you're able to get, let's say, $2 in terms of premium. Now if you were to take this by simple math, if you were to go to 60 days, this should give you, let's say, $4 in premium, right? Because you're just simply doubling it. But instead, you do not get $4. But instead, what you get, maybe you only get, let's say, $2.80, right? So you can see you get much lesser. And if you get to 90 days, the kind of premium which you get per day becomes even lesser. So if you were to take just simple math, 30 days times 3, it should give you $6, right? Because you just times 3, because it's just 3 times of 30 days. But instead of $6, maybe you only get $3.30. Right, so as you can see, the premium which you get per day really drops off as the number of days increases. So that is why the sweet spot is usually around 45 to 60 days, where you get a good decent amount of premium. At the same time, you also get a good decent amount of theta decay. And at the same time, you will see that the expected move is greater than the realized move. So that means that if you were to trade the expected move within the 45 to 60 days to expiration date, more often than the 68% suggests, right, you will be profitable. Alright, so this is all theoretical. So how does it actually plays out, right, when you actually start trading it? So what I did is I actually put on a year's worth of trades where I trade the expected move, and then I'm going to show you the results, and we'll take a look together to see whether is it true that, it's more than 68%, right, more than the probability suggests, where it says, where it's supposed to be 5%, or whether do I actually only hit 68%, or is it lower? By the way, if this video has been helpful to you so far, I greatly appreciate if you hit the thumbs up button and also subscribe to my channel so I can create more videos like this for you in the future. Okay, back to the video. Alright, so there are a number of different option strategies that you can use to trade the expected move. So for this, what I did is I traded the Strangles. Alright, so in my previous video, I talked about the top 3 most profitable market neutral trading option strategies, right? So basically, it doesn't matter where the market goes, as long as it stays within the expected range, then you are able to profit, right? So if you're not sure what the Strangle is basically just a short call and a short put combined together. All right, so let's, for example, you just take a look at this price down here. So what you're going to do is you sell a call above, and then you want to sell a put below as well. So basically, where you place the strikes is where the expected move is, right? So for this, what I did is that I tried to place as many strangle trades as possible. I place it at different dates, different prices, different expiration dates, to try and get as many trades in as possible so that the probabilities will work out. So as you can see, this is all the Strangles trades that I did for 2022. Alright, 2022, as you can see, there are winners and there are losers, and there are quite a number of losers down here. Alright, this is where the market, right, became more volatile than what the actual implied volatility is. But at the end of the day, as you can see, it was profitable, right? So for this Strangle, because as you know, this is a naked option strategy where you have a naked call and a naked put, I did not want to hold it all the way to expiration. So for this, I got out at roughly around 21 days to expiration because I did not want to gamma to pick up. So whether it's a win or a loss, I will just get out at around 21 days to expiration. So here's the summary. So total, I did about 68 trades, and then there were 46 winners and there were 22 losers, and the win percentage is actually only 67.65%. And interestingly enough, it's basically what the probability suggests, right? The probability already suggests that it will be 68%, and that's exactly what I did, and I did not actually get anywhere near 85%. And the reason for this is because there's not a large enough sample size, right? So for any statistical significance, you need to at least have a couple of hundreds to even 1,000 trades for the probability to play out, right? It's just like you're flipping a coin, right? Whether to get heads or tails is a 50-50 chance. Now, if you were to just flip the coin 10 times, it's very easy for you to maybe get heads 7 times and then the tail just 3 times. But does this mean that the coin is a 70% chance that it's a head and 30% chance it's a tail? Definitely not, right? Because if you were to flip a coin closer to around 1,000 times, then that's where the probability will start to go to around 50%, right? So that is where the law of large numbers comes in. You need to have many trades that comes in. Now, the second thing to note is that although we only had a 67.65%, at the end of the day, we were still profitable. So it doesn't mean that if your probability is around the same as what the probability suggests, that you're not going to be profitable. No, it doesn't mean that way. You're still going to be able to be profitable as long as you manage the trade well. Now, as you know, the strangle is an undefined risk strategy. So theoretically, the loss can be unlimited. But probability-wise, that is highly unlikely. In fact, the biggest loss would most likely just be 2 standard deviations, right? So 2 standard deviations is basically the buying power requirement that you would put up for this trade, right? So for the IWN, it's roughly around $2,000 to $3,000. So that's basically what the broker would suggest could be the maximum risk. Now, of course, there are times where you're going to lose much more than that, especially like during the COVID crash. But that is why you need to keep on putting all these trades on, right? Keep your position sizing small. So as you can see for this, all these are pretty small relative to my account size. So as you can see, the biggest loss is only $1,495. So this is where you can control the losses when you do hit the losses. So you can see from the stats down here, my biggest winner is 425, and then the biggest loser is $1,495. Now, this is something that's very common for undefined risk trading strategies, right? For option trading strategies that's undefined, because when you have a option trading strategy where the probability of win is quite high, most of the time you're going to have smaller winners and then you're going to be much bigger losers, right? So although your loser is much bigger, it's being compensated by the high win rate which you have. So most of the people, or rather most traders, are just used to, you know, having big winners and then many small losers. But in this sense, right, this is the opposite, right? You're going to have many small winners, but then you're going to have the occasional big loser as well. What's important is that at the end of the day, as long as you're profitable, then that's what matters. Okay, so you can see the average winner is about $249, but the average loser is actually not too far off. It's about just only about $30 or so, slightly more than the average winner, and that's because the number of losers which you have is going to be much lesser. So when you average them out, your average loser is going to be actually much lesser. So let's calculate the expectancy. So if you're not familiar with what expectancy is, basically it's a way for you to calculate and see whether your trading methodology is actually profitable, right? So for this, the expectancy, the way you calculate is basically the percentage of the win rate times the average winner minus off the percentage of losers times the average loser. So you can see it all pans out to 77.61. That means on average, every time I put on the trade, I should be expecting to make $77.61 altogether in the long run. So as long as I have more occurrences, so let's say if I have 1,000 occurrences, let's say in a year, then what I'm looking to make is actually roughly around 77 times 0.61 times 1,000. All right. So you can see overall this is a profit. Now, there is another way that you can actually trade the expected move, and the other way is using what's called the put ratio spread. Now, the put ratio spread is different from the strangle because there is only one side of the risk. So if you're not familiar what the put ratio spread is basically a short put. All right, you have one short put, and then you use the credit from here to finance a debit spread, right? So basically you have a put debit spread here where you have a put option and then another short put. So total you have two short puts and then one long put. So this makes the put ratio spread. So if you were to take a look at the risk graph, the risk profile of the put ratio spread, it will look something like this. All right, so as you can see, there is a 10 shape somewhere down here, and the market price would be normally somewhere around here, right? So this is where normally the market price is. So as you can see, there is this 10 shape here where the profit will be the highest if the market actually goes down into this 10, and you will only basically realize this big profit down here only when it's around expiration date. So for the put ratio spread is very different from the strangle, because the strangle, first of all, it has both-sided risk, right? You have the risk to the upside, you have the risk to the downside. Whereas for the put ratio spread, you see there's absolutely no risk to the upside. So the market can keep going up for all I care, and then I'll still just get the premium which I receive for selling this put ratio at the start. But as it goes down, you see, there is an opportunity for me to make much more than the credit I receive. And then, but if it passes past this break-even point, then that's where this put ratio spread will start to lose money. So before it can actually start to lose money, I want to make sure that there is a chance for me to make a lot of money. So this is pretty much a very defensive move. So for the put ratio spread, what I did is I basically placed the short strike down here at where the expected move is. All right, so this is another way for you to trade the expected move. So the put ratio spread, what I did for here is I try to put on as many trades as possible, and the difference between the put ratio spread and the strangle, one thing is that the put ratio spread is a slow spread, so that means I want to hold all the way to expiration because I want to have a chance to hit this big profit zone down here. All right, so for this, I actually traded on the XSP, which is the S&P 500 mini SPX options index. So for this, there is no chance of early assignment because this is European style options. So basically, all your profits and loss will be realized only at expiration, and this is a cash settlement. All right, this is a cash settle option. That means there is no assignment of shares at all. So once the option expires, right, so they will calculate whether you are in a profit and a loss, and everything will be settled in cash, right? So if you're lost, they will take the money out of your account, and if you're in profit, they will just put the money into your account. So as you can see straight off the bat, you can see that there are many more winners, and the reason is because the put ratio spread is a very, very high win rate kind of strategy, right? So if I were to go back to take a look, if you take a look at the risk profile, if the expected move is down here, right, your break even is much lower than this because you have this embedded long spread down here. So your win rate down here is easily anywhere from 80% to even 90+%, right? So that is why you see that there is a lot of wins compared to losses in these trades, all right, in this put ratio spread. So again, the summary down here, total there's 51 trades. All these are all held to expiration. So you can see the winner is 49 winners and there are only 2 losers. So the win percentage is actually very high. As you can see, it's 96.08%, and this is definitely much higher than what we saw in the previous table, because remember the previous table which you saw where there is the actual occurrences within the expected move is 85%. But in this case, it will be higher because you've eliminated one side of the risk. So there's no risk to the upside, there's only risk to the downside. So as you can see down here, the biggest winner is pretty close to the biggest loser. And that is because of this tent down here, right? This tent shape down here. So you're able to actually make a lot if you hit this tent down here and you realize the max profit. So you can see that the biggest loser is only around 2010. There's only one time. The second time we only had roughly $190 loss. So you can see that for this, the average winner again is smaller than the average loser, also because the most of the time when the market goes up, you can see that it pretty much just expired worthless, right? So I just collected the credit right at the beginning. So for this, the expectancy again we calculate is roughly 395.73, and the overall profit is $20,182. So for this, the put ratio spread actually did much better than the strangle, and the only reason is because in 2022 this is pretty much a bear market. You can see that generally the market has been going down, and the put ratio spread makes the most money when the market is below the current price where you put it on. So there are many times, as you can see in this trace which I have, you can see there are a number of times where I hit the tent, right? I hit the tent where I'm able to get much more than the actual premium which I sold it for, right? So there are a number of times, because the market is in basically a bear market, the market goes down. So this is one way for you to profit in the bear market instead of just doing, trades like iron condors or strangles. All right, so although this expectancy here is pretty high, chances are it's not going to stay this way if the market resumes its bull market run, right? Because in a bull market, as you know, the market will keep going up. So most of the time, if it keeps going up, you're going to miss this 10 and you're just going to make this a premium which you sold for at the start. All right, so this expectancy, chances are it's going to drop off in the bull market and it's going to pick up again in the bear market. So overall, the put ratios has been very profitable for me for 2022. So if you want to get much more consistency in your profits and in your results when you're trading options, then you want to look to trade expected moves options trading strategies. All right, guys, so I hope that you found this video very helpful, and if it has, I appreciate it if you give me a thumbs up and also subscribe to my channel as well, so this way I can create more videos for you as well. And as always, thank you for watching. I appreciate your time, and may the options favor you.